welcome back to the Commodities Dig. I'm Amy Hogan, and I am joined today by David Harquail, CEO of Franco-Nevada. David, thanks so much for joining me.
Pleasure to be here.
So we were both actually just at the Denver Gold Forum.
Mm-hmm.
How would you describe the tone of the forum this year?
It was much more active and party-oriented than I expected. I was expecting something more subdued, so I was actually frankly surprised by the size of the crowd. And I have the Barolo Wine Index. You know, there's way too much Barolo wine flowing. So to me, it says this is not really a market bottom. You know, I've seen it before in 99, 2000, and 87. This was still. You feel. I'm always hoping to see some anecdotal evidence that now is the time absolutely to buy, and I couldn't see that from the Denver Gold Show.
Do you think companies have adjusted to where the price of gold is right now?
No, I think a lot of them are still hoping the gold price will come back and advance projects that they have on the back burner right now. I think it's been slow. I think was most humbling, I think, for most people is we were beginning to have that momentum for gold prices going into the summer, and then pulling back again just before the Denver Gold Show. I think people were saying, geez, we're really going to have to get serious on G&A and some of our projects in terms of getting our operations in line. So I think the longer that this lasts, the more people are readjusting their business models. I think there has been the last year and a half, hope it was just be a temporary dip. So there's more pain to come if we don't see gold prices improve from where they are right now.
And how does the gold price impact you guys?
With the gold price going from 1,600 to 1,200, our GEOs have almost compensated for that. So we're still, this year we're targeting, revenues or GEOs that were substantially above what we did last year. But the revenues, of course, if you put your own gold price forecast, wasn't much different. I think that's changed now because one of the unique things is the Candelaria deal that we've just announced. When we close that in November, we actually get to book the revenues since July the 1st on that operation. So we should have a very good quarter. So I'm expecting actually for 2014, we're going to have a record year in terms of revenues and attributable GEOs. And then with Candelaria, as I said, that's about a 25% increment on our ounces. We're going to have a gangbuster year next year. So I'm very proud. We're in a great position. We can grow our company despite the challenges within the gold industry. So the cycle is our friend. This is the time to buy. We're trying to take as much advantage of it. I'm hoping when the equity markets come back, I can give my business development team a good long holiday.
Do you expect things to change a lot in the price of gold over the next year, or do you think we'll have similar prices to what we've seen in 2014?
Amy, we don't know, because gold is just the tail of a larger economic macro situation. I think we have some great board discussions. Our board is made up of mostly former CEOs, and we had a great off-site meeting in August. Pierre Lassonde had just come back from Europe, and he came back actually very pessimistic about the European situation. That they have a lot of things to do to get their house in order, and the potential is we can still have a liquidity crisis. A liquidity crisis could be negative for gold in the short term, but we're absolutely confident for the sort of the time frame that we're buying assets. From life of mines that are 20 years plus, we're going to average much higher gold prices than we are right now. We just see that there's not a lot of new supply coming in. The demand is great, and we also see gold as the anti-dollar. And a lot of people have been distressed by gold in the last year and a half, but that's because the dollar and the S&P 500 has been so strong. And now, in just the last couple of weeks, you're beginning to see a little more glimmer of hope on gold because there's been some pullback on the S&P and on the dollar. And so our time is going to come, and that's why I talked earlier is we try to just invest the cycles. When people are selling, that's usually a good time for us to buy, and when other people are buying, it's a good time for us not to spend our money, just accumulate cash. And on the gold price, we've got that long-term confidence. We're a gold company. I'm just delighted now we've increased our precious metals exposure to over 85% with this latest transaction, and setting our sales to be exposed to good things with the gold price over time is going to be great, but we've got a great business in between. We've got the business that's the most robust and most conservative, I think we have no debt. We'll be cash flowing because we're producing from 48 different mines. I can't imagine a scenario where we can't cover our overheads and our dividends, even in a downturn for the gold price such as we saw in '99. So I like the position we're in. We're making exposure to the gold business a business, And again, I talked earlier about, and for investors, they can choose gold operating companies. Huge torque if the gold price comes up. They'll make lots of money. But if you're wrong, okay, if you want gold exposure, less risky is the gold ETFs. But in between, we call ourselves the gold ETF on steroids because we can give investors that exposure to gold, but we can also pay them a dividend, and we can pay them an alpha because people make new discoveries on our properties. And so that's why we just have two models. The gold investment that works, the gold ETF on steroids, that's Franco-Nevada.
Well, I think we should end it there. That was perfect.
Okay.
Thank you so much for your time today.
Amy, pleasure. Thank you.
This has been the Commodities Dig. I'm Amy Hogan. Until next time.